Welcome back to Live Lunch and Learn. I'm your host, Lambros Demos, and I'm very excited today to bring back a special guest. He is a rock star in the mortgage industry, Vince Gaetano. Vince's resume speaks for itself. He is a straight shooter. And what I really appreciate about Vince is that he always has some great knowledge to share, which is why he's here. So without further ado, I'm going to bring in Vince. Hey, Vince, how are you?
Lambros, how are you? Thanks for having me back.
Oh, always a pleasure. Always a pleasure. Thanks for coming back. How are things? You're pretty busy these days, I guess.
You know, surprisingly, usually this is a time of year where things kind of taper off a little bit, but
Okay.
we've just been bombarded with a lot of activity, a lot of inquiries. I guess the recent couple rate increases on the fixed rate side has prompted some people to move and make decisions a little bit quicker,
Okay.
which is surprising for this time of year, but nonetheless, we're here to serve, we're here to help and provide some guidance and calm down the anxiety and the fear that's out there, because I think it might be a little bit premature to start thinking things are going to be spiking anytime soon.
Yeah. So that's a good point. Fear is a key word. There seems to be a lot of that in different ways. So I think a little bit, not sure what's happening. Vince, can you hear me? Are you
I
still
can hear
there?
you. Yeah, I can hear you.
Yeah. Okay. Okay. Perfect. So, so speaking of that, now you mentioned fixed rates have gone up. There's been talk about variable rates going up as well. I think there was a report or a comment made by the head of Scotiabank that variable rates would increase 8 times in the second half of 2022 and early 2023. What are you hearing about that? Do you know anything? What's your comment about that?
You know, I'm a little bit skeptical on those numbers. I do believe there will be a rate increase coming, probably as early as April 2022 on the variable rate side of a quarter
Okay.
point. I
Okay.
don't suspect that we're going to be seeing any increments of more than a quarter point. I think they're going to ease in to a possible rate increase. But let's put everything into perspective. Okay, we're talking a quarter point. We still have clients in variable rate mortgages at less than 1.5%.
Yeah.
The qualifying rate for anyone who's borrowing money on a mortgage basis is being stress tested at a qualifying rate of 5.25%. So,
Yes.
you know, we have to put everything into perspective. Is there a need for rates to go up? Yes. When you have inflation at the levels they're at, it's going to drive some type of action by the Bank of Canada or central banks around the world to do that. But the reality is there has been a huge savings being stocked away in bank accounts in Canada. I think the last figure noted that Canadians saved over 200 billion during COVID and pretty much wiped out a big chunk of unsecured credit card debt. So we are seeing a shift of homeowners and consumers trading in high interest rate debt for lower interest rate debt. They're saving on interest costs and borrowing fees, and they're doing it in a more intelligent way. They're being more proactive, and they're being prudent with their money. You know, we talked about this not too long ago. You know, our office is near the Yorkdale Shopping Mall, and I go in there quite a bit. I go do some banking and stuff like that, and
Yeah.
there's not a lot of people walking around with bags. And that concerns me. I think people are window shopping. I think they're trying to figure things out. There's a lot of consumer goods not here for the Christmas rush. We have supply chain disruption. And I think we're maybe 18 months to 24 months before that fixes itself. And these are real issues people have to come to grips with, because if there's no supply to buy here, people are going to continue to save, and they're going to have the resources available to withstand a potential rate increase of a quarter point or half a point over the next 12 months.
Yeah, no, all very good points. That's a lot to consume right there. So I just want to scale back a little bit here. So, I mean, when interest rates, variable rates start going up, a quarter point is nothing. Do you think there's going to be further after that? Do you think, because I heard the target rate is to get back to 2.25, 2.5. Is that something that is, likely to happen in the next 18 months to a year, 2 years?
There's no question we will see a number of rate increases.
Okay.
I forget which institution or which economist indicated that we're looking at 8 increases of a quarter point, which is 2%. I think
I
it was
think it was
Scotiabank.
Scotiabank.
I think
Yeah.
it was
Yeah.
Porter who mentioned that.
Okay.
I really have a hard time believing that that'll be the case.
Okay.
I saw a Manulife report. Their economist, who I really enjoy. She's a lady who I forget her name, but very, very astute. And they think inflation is going to taper off next year. We saw September come in at 4.4%. We believe that the year will be at 3.1. And of course, this is all manipulated by the government, and they can kind of control and say what inflation is. They could decide what it's going to be.
Right.
To anticipate 3.1 when we still got a few months to go. It's always going to roll your eyes and say, okay,
Yeah.
well, you can make whatever you want. But everybody's
Sure.
inflation basket is different.
Yeah.
And Manulife's indicating that next year will come in at 2.6%. So with some supply chain disruptions easing, we're going to see inflation come in line. That will in turn not drive rates to go through the roof. Okay, because if they continue on this path, I think there's no choice but to increase rates. But let's keep everything in the perspective. Let's say prime and the variable rates go up 1.5 points.
Okay.
We're still at 3%.
Okay.
Right.
Yeah.
You're qualifying at 5.25. You're still within the band that you would qualify for that mortgage. So what I caution people on when they're nervous about this is start adjusting your mortgage payment higher. Start anticipating the increase. You have privileges within your mortgage contract to increase your mortgage payment on a periodic basis. Do so. Take advantage of it, right? Accelerate repayment of your debt before it forces you to do so. And these are the tactics and the strategies we help our clients with. If you're really nervous about it, let's talk about it. Let's come up with a plan to combat it. And let's put this rate increase in a dollar number so you know exactly what's coming. Yeah. What does a quarter point mean in dollar values to everybody, right? Every $100,000, it's about $250 a year.
Okay.
So it's $20 a month. Right. That's $10 every 2 weeks, give or take. So all of a sudden, people could start internalizing what an increase means to them.
Yeah.
Right? And when you do know that and you're prepared for it, it's not as impactful.
Yeah. No, those are some great points, some great advice. And people, I guess, I'm not sure how it works, but they would have the option to lock in, would they not? If they fear that the variable rate will continue up, isn't there an option to lock in to a
fixed rate?
A fixed rate. That's
well, Lambros, it's funny
sure
because
fixed rate.
Banks want you to be in fixed rate mortgages. Okay, there's a reason why.
That's right.
There's a penalty to go from fixed to variable, and it's free
Yes.
to go from variable to fixed. So when you think about it that way, you have to wonder, why do banks want to push people into fixed rates? Number one, they can solidify their profit margin.
Yes.
Number two, the penalty is quite punitive to break a fixed rate mortgage. We had a case this week where a client was going through some marital issues. They had to sell the property because they're splitting up. Penalty on their mortgage was $44,000. $44,000. The person almost reconsidered wanting to stay with their spouse. It was almost enough to have them change their mind.
Wow. Which is more expensive, getting divorced or paying the penalty?
So, like
Oh,
these penalties are punitive.
yeah,
So, I always caution people before you lock in,
yeah.
life happens.
Okay,
5 years is a long time. A lot can change in 5 years. Do you
sure.
really want to be under the pressure of being locked in? And I call it pressure because the penalty is crippling.
Yeah,
It's the interest rate differential on a posted rate that no one ever pays
that's right. That's right.
is excessive.
Yeah,
And when you're carrying the mortgage balances most GTA residents are carrying, those penalties are crushing. Like they're just like, sorry to say, you
yeah.
almost shit his pants when he heard the number. Like it was bad. It was
I
a
believe
big,
it. I
big
believe it.
number.
Yeah, for sure. And I don't think the banks do a good job of explaining what that penalty will be because they don't refer to the posted rate. They always say, okay, this is the rate we're going to give you. They don't tell them this is a discounted rate, but we're going to charge you a penalty on the actual higher posted rate, right? So,
And Lambros, that's a very good point you brought up.
yeah,
I would bet dollars to donuts that if you went into 10 different institutions' branches and asked 10 people how to calculate the interest rate differential, you get 10 different answers.
yeah, yeah, I believe it. I wouldn't take that bet because I believe
And
it's
what the
true.
variable does is it's a simple calculation. It's 3-month interest. And I'm wondering, with a tremendous shift of people moving to the variable rate mortgages, I think last month or last quarter was almost 56% of people took variable rate mortgages. So it's becoming the majority of people's choices when making the decision. Will banks alter the penalty structure on variables? That's going to be really interesting to see how that plays out, because if they're vulnerable and people leaving at a 3-month interest at the rates this low,
Yeah.
it could prompt a whole redesign of the penalty structure on that product. So I'm interested to see if anything happens, or they just leave it
Yeah,
as is.
that's a great point because banks don't like losing money, and wherever they can, take from the consumer, they will do that.
Yeah.
Unfortunately, that's the world we live in. Speaking of, banks and et cetera, you mentioned inflation a few minutes ago there. Well, you mentioned supply chain. Uh, what's what's inflation going to be looking like in the next? Because it's been. Is it my imagination, or have things accelerated quicker over the last year or so in
Well,
terms of inflation?
I think there's a few things that people need to think about. Number one, when you're going out into the whole service sector, let's talk about restaurants,
Okay.
outdoor dining, entertainment type facilities. These are
Yeah.
people that have been out of business for pretty much a year and a half.
Okay.
So,
Fair.
you go to a restaurant, I'm seeing some major sticker shock on
Yeah.
prices of alcohol, on entrees, appetizers. Everything's moved up. It almost seems like they're trying to catch up on revenue
Yeah.
loss during
Exactly.
COVID period. So there's, I don't know if that's uh, going to be a long-term issue moving forward, or it's just a catch-up, right?
Yeah.
Then you have the supply chain issues. I think from a supply chain perspective, if there's no supply and people need things, let's talk about the real estate and construction industry, right?
Hmm.
Lumber, materials,
Yeah.
finishes of homes all went up. Labor went up. People are needing things done quickly, not enough skilled trades. So those services are going up. And then, of course, I think we have to look at all the new taxes that are being imposed. One being the carbon tax. I know that some people, I did a post about how gas prices went up 30% in
Yeah.
a year, okay? And somebody says, well, Vince, that's nickels and dimes, right? Like, how much is a few cents a liter going to really impact you? Well, if you're
Yeah.
doing a lot of driving and
Yeah.
people have had to drive until they qualify and they're driving a lot further
Yeah.
because now they're going back to work, it's
Yeah.
going to be a big difference. But I think fruit, vegetables, meats have all gone up in the grocery stores.
Yeah.
Everything is moving up.
Yeah.
But what I think could curb and could be the saving grace is that COVID taught a lot of people the difference between wants and needs.
Mm.
And I think over the last 18 months, Canadians have done a remarkable job saving and living without things. So
Yeah.
I believe the toys, the dust collectors, I like to call them, probably aren't going to be in the stocking stuffers, stocking stuffed in stockings and under the tree this Christmas. I think people are going to start
Yeah.
thinking about experiences, spending time with their loved ones and their friends, as opposed to buying them trinkets and trash. I call it. You know, that's the language I like to use on some of this stuff. So I
It's
don't know.
okay.
Inflation.
No, it's good. It's You're absolutely
Pardon?
right. You're absolutely right, and some great points there. Just going back to the gas prices, yes, it's pennies that it's going up, or sometimes even fractions of pennies, but it's also conditioning the general public, because every time it goes up, and then we're surprised, and we get used to it, and it goes up again. So it's not just the one increase, it's because it's continuous, right? So people are thinking, wow, it's almost at $1.50, and people are going to get conditioned to that now. So when it jumps up to $1.60, they're going to say, well, that's high, and it's going to fall back to 150. Oh, gas is cheap, I'm going to get some gas, right? So
But
that's the game that's being played there.
and what's interesting is, I remember one post received a comment saying, well, look, this is nickels and dimes, it really doesn't make a difference. But let's look at the mortgage costs, right? We had posted 5-year fixed rate at 194. It went up to 214, I believe. So that 20 basis point increase on 194 is over a 10% increase in the cost of borrowing. So even though it's 20 basis points, it doesn't seem like a whole lot. That's $200 per 100,000 in borrowing. It does represent a 10% increase on the base interest rate that used to be charged. So inflation's here; it's real. But I think it's important that people start taking note of their own inflation rates and look at what their own household is spending. The basket of goods doesn't apply to everybody that StatsCan uses to calculate inflation. I really encourage everybody to start tracking what they spend money on and look at your receipts, keep them, budget, and see what you're spending on different segments of goods that you require to operate your household. And you'll be surprised to see what your personal inflation rate is. It's probably going to be a lot more than what the government's telling you it is.
Sorry, Vince.
Lambros, you're back.
Oh, were you carrying the torch there?
I was. I figured you had some technical issues.
Yeah, I apologize. I'm not sure what's happening here.
I talked about how everybody should start looking at creating their own inflation rate for their household. Excellent. And how they should start tracking what exactly is being used to run your home, and look back at what you spent. Look at what you're spending today and determine your own personal inflation rate.
Yeah.
Because everybody's different. The government's basket of goods is manipulated. The weightings are way off, and they're using items there that, although they call it a core inflation rate, not everything in that basket of goods pertains to your lifestyle and your household.
That's true. No, that's a great point. Everybody, I think, should have their own household budget and keep track of things where they're spending, and then look back on it, because you'll be surprised where you spent money, and it's like, oh my gosh, I spent all this on Starbucks or whatever it is, right, without realizing it.
And what's interesting, Lambros, is there's some fantastic tools available and applications that people could use to track this stuff. There's I had Nathan Kennedy on one of my shows. He's a young, up and coming financial literacy guru.
I've seen Nathan's posts.
He's got a podcast called the New Money Podcast. Great kid. He talked about this application he uses called Mint, and you could download your bank accounts, you could download your credit cards statements, and it kind of puts everything in categories, so you could track where you're spending your money from month to month.
Sure.
So I think people need to start being prudent and seeing where they're spending money and look at opportunities to save, because with inflation coming, and it's going to be here for a bit.
I agree. I agree. But even for some people who aren't tech savvy or et cetera, just a simple spreadsheet, right? Just put the months, put your expenditures down, and groceries, gas, whatever it is, coffee, et cetera, et cetera. Just write them down, and then look back and say, hey, why am I spending? For example, I've got Amazon Prime because I order a lot of stuff. But if you're not using that, if you're not getting, everybody loves Amazon, but if you're not using it to its advantage, why pay the $9 a month for it, right? Things
Every
like that,
year I joke about this, but I call Rogers and play them off against Bell
right?
on the household cell bills,
Of
because we
course,
got
yeah,
kids, my wife, we got 5 cell phones,
yeah,
and
yeah,
I'm always renegotiating my
sure,
plan. And I average about 16 to $20 a month
yeah,
savings every
yeah,
year, which is $240.
sure,
So,
sure,
that's a big win. For some, and might be a little win for others, but it's $240 I don't have to give
for
to a
sure.
cell company,
Yeah,
right?
yeah, and people don't realize that they can always renegotiate with Rogers and Bell or whoever it is, right? Because they're always going to offer you discounts or some kind of savings in order to keep you as a customer.
Agreed.
Yeah,
And there's your opportunity. And you look at your subscriptions. Are you using them all?
yeah,
They creep up their costs every
mhm,
year. They give you a little bump, and it's a few dollars, but it's a few dollars every month. And if you're
right.
not using it, get rid of it, cancel it.
Exactly, exactly. That's exactly it. And you don't need to do a lot of work either. Like I said, just write it down on a spreadsheet and just track everything for a couple months and see where you're spending and where your money's going.
Agreed.
Yeah, excellent, excellent. So home prices are astronomical, right? Everybody knows that. I'm working with some buyers right now who, I mean, a year ago they could have entered the market at under $1 million. Now they're looking at the 1.3 or higher. So how do we get, and I think millennials are the largest population segment, if I'm not mistaken, right? They all want to buy houses now without the help, with or without the help of mom and dad, I guess. But I've seen some of your posts, I've seen some of your videos where you say you can help people get into the market. So how do we help people get into this kind of competitive, expensive market?
Well, when you look at the big picture, as much as house prices are going up, the difficulty people are having in qualifying for mortgages is the stress test. The
Okay.
stress test is what is preventing people from getting into the market at these low rates.
Okay.
And one of the things that we're seeing a lot more of, and we're recommending to millennials, is get your parents to co-sign. If you
Okay.
have additional income that could help you support the loan and pass the stress test, it could still get you in at cheap money. So the difficulty is the stress test at 5.25, because remember it was 479. They bumped it up to 5.25, pushed a few people out there, and now with the advent of the cap still being $1 million for CMHC. Now,
Right.
during the election, they did indicate that they're looking at increasing that
They're
to
going to increase it.
1.25 or possible, but it hasn't happened yet.
Yeah.
With the cap still at $1 million, we're still seeing parents help out with down payments in
Okay.
the form of gifts. There was a stat just recently this week. Ben Robideau of Edge Analytics Real Estate. He does a great report. I really enjoyed him. I'm a subscriber. And he talked about how many parents are helping their kids
Yeah.
get into the market. And the average gift amount
Right.
is ridiculous. Like we're talking over $100,000,
Wow.
130, 180,000 or something like that,
Right.
depending on the markets.
Yeah.
So there are solutions for people to get in the market. They just have to be a little bit more open to the idea of maybe having their parents co-sign. And
Okay.
I do respect the fact that people want to do things on their own.
Yeah.
But the system's not helping you, right? The rule of thumb is you qualify for 4.5, 5 times your income.
Yeah.
Under the stress test, even though you may be paying less than half the interest rate that the stress test is calculating you at.
Yeah.
So that extra help is something that is available. And Teranet, who manages land registry for the province of Ontario,
Right.
has indicated in some stats that I've been privy to that the gap in age of the people on title has gone to over 25 to 30 years in some cases, and that is evidence that parents are co-signing for their
Wow.
children on mortgages because they could track the age of the person on title. So the gap is widening, and
It's
that's
widening. Yeah.
it is
So,
because of parents co-signing.
so do they actually have to co-sign, or is a gift enough to get it done? Because if they co-sign, they're on title. When they want to sell or move up down the road, then the parents are hit with the capital gains tax, are they not?
Well, in most cases, they go on as guarantors.
Okay. Oh, I see. Okay.
As a guarantor, they're not on title, but you make a very good point.
Yeah.
When they do go on title, they are an owner of that property, but you can specify that they're a 1% owner.
Okay.
And the income, that's what we do. When a lender insists that a strong co-applicant go on title,
yeah,
we indicate that it's a 1% ownership.
Okay.
And that way the capital gains, if it does come into play, is negligible.
Okay, very good.
Yeah.
Good. I'm glad you explained that.
But it's starting to become more common, and with it becomes it causes more delays because now you have 3-4 people on title.
Of course.
You have 3-4 sets of documents of income validation, down payment, cross collateralizing of assets and stuff like that, or cross pollination. So it just becomes a little bit more complex,
right?
And it slows everybody down.
Yeah. Wow. A lot to not to take in there. That's great. But I really appreciate your time, Vince. This was a great segment. I apologize again for the technical difficulties.
No problem. I didn't lose
watching.
contact.
I'm sure you did. I'm sure you did a fine job. I'll watch the replay. That's great. So if anybody wants to get in touch with Vince, he can find him on Instagram. He does a regular live show. He puts out all kinds of great information daily. And here's his contact information.
And you know what, Lambros,
yeah.
I really appreciate the invitation. I really enjoy chit-chatting about the market and what the behaviors of people are within it.
Yeah.
To come up with some thoughts on what we're seeing.
Okay.
But you know what, this is what we like doing, is education.
Absolutely.
Helping people understand what is actually happening.
Yeah.
And I always tell people, if you're really concerned, ask questions and engage in someone that will hold your hand and walk you through it. And then you can make an informed decision. So thanks for posting where people can get a hold of me. I just announced this morning I'm doing a little contest for Remembrance Day.
Okay.
Giving away a set of Leaf tickets on my Instagram account.
Okay.
And all I ask people to do is tell me what Remembrance Day means to them.
Okay.
I think it's a holiday people don't spend too much time thinking about. It comes and goes, but I wanted to get ahead of it and wanted to get people's thoughts and think about those that helped us be in the great country we're in.
No, that's great. That's an awesome thing to do, Vince, and it's appropriate because Leafs and giving stuff away, I mean, it's giving the puck away, I guess. That's what I'm trying to say here.
And it's for a rare Friday night home game on November 12th.
Okay.
And if they're rare and it's the day after Remembrance Day, I thought it was fitting and thought it would be a great little giveaway. So
absolutely.
Hopefully some of your guests will enter and we could hopefully call a winner on the show next time.
Yeah, absolutely. So if you're watching, get in on that contest. Ask Vince questions. That's why he's here. He's happy to help. Same with me as well. So thanks again, Vince. Thanks for coming on the show. It was great.
A pleasure. We'll do it again.
You bet. Take care.
Take care.
Bye, everybody.